Hey everybody, Marty Mazzora here again for the second time today. It's Friday, May 12th, 2023. This is your weekly economic update. In front of you is the graph of our PWA index, 45 data points tracking general conditions. And as you can see, folks, we are now below the low that we set during this stage of the current cycle. We'll take a look at the handful of inputs that I've selected for you today, starting with retail sales. The red book is that high frequency one that comes out every week. And folks, this just continues to get worse and worse, despite what you may be seeing as you're out and about presently. I took in a presentation from the retail analyst of one of the research firms whom we tap regularly. And he is about as bearish as I've ever heard him. So he's digging way below the surface and he's seeing reduced traffic. He says, yeah, like you're hearing from a lot of people, earnings have beat expectations, but expectations have been ratcheted lower and earnings growth and outlooks look pretty abysmal by his estimation. So that, of course, is consistent with what we've been presenting and illustrating for you here in our economic updates. Second up is consumer confidence. I mentioned on the market snapshot this morning, University of Michigan's survey came out today, and it was the worst of both worlds. Economic sentiment down on a go-forward basis in terms of their expectations, and they actually expect inflation to move higher. Really not a good look. And as you can see, it's just at pretty historic lows here, at least recent history lows. Initial jobless claims just is going from bad to worse. Recall, as I do, I think every time I show you that, employment data can hold up and look really good until it doesn't, and then boom, very shortly thereafter, recession odds go through the roof. And look at that trajectory here of late. Small business sentiment continues to pretty much move further into the gutter, worse than the pandemic lows at this point. Slight uptick in hiring plans, but still in a very strong downtrend. And cap expenditure plans to expand is nearly at pandemic lows. So small businesses, the biggest employer of U.S. workers, says the outlook is not good, to put it mildly. Capital expenditures, top one is capital goods new orders ex defense. You can see what's going on there. This is capital goods shipments. This looks like at least the beginnings of what could be a pretty serious cutback in expansion plans, which of course is consistent with our overall go-forward thesis right here. CPI data came out on Wednesday. I believe it's like the 9th month in a row where CPI has declined, which is precisely what we told you to expect up here. It went from 5.0 to just 4.9. Did pop up a little bit on a month-on-month basis. Core, which X's out food and energy, stubborn at 5.5, 0.4 on a month-on-month basis. Producer prices came out and people got excited about the 2.3% increase. So, disinflation here as well to a pretty low level. Producer prices, although the month-over-month jumps higher by 0.2%, but still annualized, that's not too scary. Now, of course, what we've been showing you here is essentially a recession in the manufacturing space. So it should be of no surprise, and I don't think anything that we would get excited about, although I think the market rallied on that news, in terms of what that says about the state of U.S. production. A weakening economy with consumer inflation holding up. So again, we do see inflation coming further off the boil, and we do see maybe the Fed cutting rates later in the year as Fed funds futures discount. It's just that is consistent with what we think the economy is going to be doing, and that'll be dragging down corporate earnings, and that creates a pretty risky setup for stocks. Commodities as well continue to confirm the slowdown. This is the Bloomberg Commodities Index, a very broad basket. You can see it's continuing to decline, which does not speak optimistically about the current state of the economy. We also track the CRB Raw Industrial Materials Index. Now, these are things that aren't traded in the futures market, so it's going to give you the real price, the spot price, if you will, of this basket of materials, and will not reflect speculation in the futures market. You could see, well, it's holding up maybe a little bit better than other commodities that are traded in the futures pits. But on a trend basis and on a rate of change basis, it's a concerning look with regard to the economy as well. Copper continues to roll over hard. We're long-term bulls on copper, and you could say, hey, historically, that's a pretty high level. But folks, it's all about trend right here and rate of change, and it seems to be falling off a cliff. Again, not a rosy picture relative to the economy. So this is the ratio between consumer discretionary and consumer staple stocks. And if the analyst who I listened to a little while ago is right, this thing's going through the roof before all said and done, meaning discretionary stocks have a lot of pain ahead of them. You can see that at the beginning of the year, we had a big snapback rally in consumer discretionary stocks, certainly relative to staples, and staples have been going higher ever since. The concept there is that consumer staples are the things you got to buy even when you don't have any money, where consumer discretionary stocks are things that you buy when you have lots of money and you're feeling really good about your prospects. So still down significantly relative to discretionary on the year, but all the way back to the end of January, you can see what the trend has been. So something else to pay attention to that's more of a market-based discounting of economic conditions. So we're going to have to be careful out there, so to speak, as we invest and risk manage our capital going forward for a while. Folks, thank you so much, as always, for watching and listening. Hope you have a wonderful weekend, and I'll talk to you next week. Take care. Bye-bye.